Good morning, MMTs. What we're going to talk about, I've got the S&P 500 chart daily, I've got Nasdaq Composite daily, and this chart over here, I've got Dow Jones daily. And what I'm going to say is everything that you've been being taught in your apprenticeship, right down to the very key specific, right on the money analysis before the fact, is that now that we have put in our long-term sell-off, that was your bear raid here. Now we have a great bull raid. But let me tell you something, that when I look at all of the indexes, and first we will compare that with the Nasdaq comp, is that we are now on a daily 96.23% DS overbought. When we put in the bottoms and we said the bull rally, summer rally was here, it was here. This is our summer rally right now. We called this bottom here. We also called these last tops here. Now, the summer rally has been a good one from these bottoms here. That's the Nasdaq comp. But you got to remember, MMTs, at 9.14%, when stocks at that time would come down and hit support levels, they would bounce like a rocket. And that was part of that summer rally, knowing that stocks are going to bounce off those support levels because they were heavily oversold. And we had sold down this reversal that we called over here, but then we said, MMTs, and you were all here present, we said the bottom was in. And it was time to get bull. Bull has proven to work its case. From extremely overbought to extremely oversold to back here to extremely overbought at 96.2% here on the Nasdaq comp. Now, when you look here at the S&P 500 is this chart right here. And I'm going to show you here that when we put in the bottoms, we shorted this whole move down, 7 weeks down. Summer rally was here. Now here's the key, MMTs. We were extremely overbought at 11.13%. Today's rally up here, now we're at 94.45% overbought. What does that mean in the short term? It means that there's going to be complacency. There's going to be a lot less fear. The pendulum swing between bear and bull sentiment has changed. My point of it is, MMTs, now listen to me carefully. This is going to be the most important thing. On the opening bell, when you are this overbought, and you take stocks like we say in pre-market, like these ADR Sina, that you would short that high. Why? Because when you're this overbought, those shorts at the high are going to pay money. When we were making bottoms over here in the oversold condition and the stock was oversold, it was just the opposite. They'd come down and hit support and they would run furious. They would run fast off the bottoms. That uptrend, that bull rally was there because they were overbought. Now, MMT, what you're going to really focus on is that when you get to these overbought levels, that's why these shorts work. That's why this dropped from 115.92 cleared. That's a $3 drop, a little over $3 off the high. Why is it? Because we are extremely overbought. When you get extremely overbought in a short-term summer rally cycle, I'm selling up there at those resistance levels because the bull will come in and buy it. They will sell it back down. This is how it's going to work in overbought cycles. When we were oversold, it was about how stocks would bounce off of their current bottom levels and then run much higher. Now that we are in the overbought processes, individual equities will sell into resistance. We've got a 3-day buy signal. You can see it's 94% here on a daily. You can see that here on the Dow, this is a Dow chart relative to the S&P. You can see here that this one, once again, in the Dow components, is your 94% overbought. And when you are overbought in indexes, when equity prices go up to their next resistance levels, that is when it's time to snap a short and they drop down $2 or $3 off those highs. But they'll come down and they'll hit their bull rally support level and then tick up off of those lower levels. But on the opening bell, as I've said clearly, and I can also just throw this in the mix here now, because this is what we were doing. The key element, MMTs, is to understand that the Dow bull rally, the S&P bull rally, here's the Nasdaq comp bull rally, oversold. Stocks bounce off support when they're oversold. Indexes are oversold. Bam! Big bull rallies. Now that the bull rally is up toward the top of the overbought process, stocks on an intraday level, when they pop up to those highs, selling short because they're going to drop. Why is it? Because when you're overbought, you're overbought. And resistance levels are harder to go above in the shorter time frame, and selling short into the gaps is exactly what works. I will go ahead and give you the trades that we did as a comparison. So I got Nasdaq comp, I've got S&P, and summer rally here. Beautiful bull summer rally here, overbought now. I've got a 3-day buy signal here. These were the MACDs, were all in sell signals. Every index has got a 3-day buy signal now. And the thing about it is, in trade management, understanding how to trade the other side of the public model is that the public is going to buy those gaps and we're shorting them down. And I'm going to give you a perfect example of what we did on Sina this morning. And not only was it Sina, when you're overbought in these indexes, now look, when you're overbought and you're overbought and you're overbought, that means that these gaps are sold down like that. Then they rally, then they sell down again. Now, the trade management, depending on the sector of the individual name, the same trade management MMTs will continue to occur at those levels. But when they do take their levels down like this, because the short-term overbought, is that they shake out all the buyers. Okay? And the reason why they do this is because all the indexes here are overbought within their bull rally cycle. So when we called the bottom here, it was time. You learned how to do the bottom, the people that are in this group. Some of the people that are in this group that were over here, they learned how to sell short the top down for several weeks. We've had better economic data. That's okay. The trade management is that selling those gaps on the opening bell, and I will do several names today, that every one of them sold. Google made a 542 high. They sold it down to 535, and from 535.88 they come right back up to 541. So they come down. What happens is they sell that oversold condition. They pull them back down to the lower key support levels where they come up off of that bottom, and that's where you want to be the buyer on that end of the trade. Because what they do is they price the stock down on the opening bell where it's not overbought on the opening bell. When they're that overbought on the opening bell, it's time to be a short seller. The public always loves to buy opening bell gaps. There are times to buy opening bell gaps. The time to buy them is when the indexes are extremely oversold. When they're extremely oversold. When all the indexes are extremely oversold and they're going to put in their rallies, those gaps are different at that point. That means they can gap up $1 or $2, but then they can run $2 or $3 or $4 higher, and then they'll hit and they'll pull back. But there's a different way of understanding how to trade gaps. Oversold market has, when stocks gap up, they gap up and they tend to run higher. When you're extremely overbought in a market and they hit the high end of the gap, like I showed on that Sina chart, and I will show another 20 stocks just like it. And understanding these trade management scenarios is that they sell them on the open, they bring them down to their key support levels, and then run them back toward their highs in a lot of cases. And it's really good trade management to know how to trade that opening bell, knowing how to trade gaps, knowing where the indexes are. Great bull rally, overbought. Great bull rally. We called these bottoms right here. All of you were here when we said the party was over, that it was time to get bull, and it was time to get bull, and it was time to get bull on all of these indexes. It was time to get bull. You were all here when it was time to get bull. And basically, it is a great, great, great thing to learn, because oversold, overbought has different individual equity trade management, option trade management, risk management, knowing when to sell up at the top, knowing when they're going to come back to that lower area and hit a lower low at a bull market support level where they're going to bounce right off of there. And that is going to be the true ranges between oversold and overbought. And we've already went through this bottom together. We've enjoyed this bottom together. Okay, we enjoyed that sell down together. We enjoyed calling the tops together. We enjoyed identifying how bottoms were made, how tops were made. And all of the live analysis is on stockmarketfunding.com on the homepage. We call the tops. We also understand how bottoms are made. We also understand that bull cycles and bear cycles, oversold bear cycles, we're entering another phase of overbought, short-term overbought bull cycle. And understanding overbought bull cycle, oversold bear cycle, trade management, and how they interact on an intraday level in the equities is everything. And we are going to get to a point where we continue to sell short. Lots of good economic data came out last week. We'll continue to use the same trade management. We will learn from these categories and topics. We will have plenty of overbought rallies. We'll have plenty of over bear rallies, oversold rallies. This is the way that this has been. Now we're going to deal with the earnings season. But the trade management, my MMTs, is the key. How does the public want to buy at the high of the open and you're selling short and it's dropping like a rock? Then it takes that buyer out, that bought on that open, takes them out of the game. They get stopped out, they get shook out. Then you're selling short all the way down. And I'm going to do lots of key stocks today. I will do the Google. I will do the Baidus. I will do the Amazons. I will do every one of those so that you will know how to take those videos, those key Pacific stocks, and relate them to overbought cycles and why they are great moves and great bull cycles, but why are they shaking people out on the opening bell $3 or $4 or $2 down off of those highs? And that's where the trade is. That's where the trade against the public is. Then when they get down to the bottom, they're always going to disappear, and that's when you're going to get net long. And it's all going to be tied to indexes. It's all right here. This is your rally. Officially overbought. Now remember, complacency and the fear factor and the fear levels is that when you're overbought, you're going to have very little fear in the market. And you're going to have a higher degree of complacency level, MMTs. And it's very, very, very important that you tie that in with your trade management and why you are always coming out ahead and why you are understanding and learning the true market mechanical pricing mechanisms